Hello everyone, and thanks for joining me. Aviva's just released their half-year results, and the market reaction has been very interesting. Now on this channel we follow my journey to the very long-term £1 million portfolio by 2050, and Aviva is one of my larger holdings. I'm very interested to see how these results will come out. Now they've produced some really large packs, one of them is over 100 pages and the presentation's over 40, so I won't grind through them because that's going to be some heavy reading. But I will highlight some of the key outcomes from their results. So let's jump into that screen and take a look. So the last 5 days, the share price has been £4, £4.10, and we're at £4.65 almost now, up 50p or 12% today. The market has received the results very positively. I've not seen a movement like this on Aviva before. This is very positive market reaction. So looking at the summary here, Aviva is going to return more money to shareholders. And so this combination, as well as better than expected operating profit, that has really boosted the stock's position in the market. The operating profit's up 14%, great figure, and that's notably ahead of the consensus forecast 742 million against 829. The interim dividend for the year at the halfway point is 40% higher than the previous year. So 7.35p plays 10.3. That's a decent increase in the dividend. Aviva recently have spent a lot of money buying back shares, and also they've done a return of capital, somewhat controversially. Just as a note, if you wanted to get the lowdown on that return of capital, I'll link in the video that I did on that explaining it. So back to this video. Now, they're going to return more money, and because the cash generation was higher than expected, they can actually perform these share buybacks. I think there's an interesting school of thought on share buybacks. The key thing is it's a permanent advantage to investors. I think Warren Buffett likes them because it increases your earnings per share. But even if the company doesn't perform better, you as the shareholder own a higher percentage, and therefore your earnings per share are higher, so your stock is valued higher. Some may call that fake return because the company hasn't necessarily improved. They're spending money on something that sort of almost disappears. You haven't actually improved the company itself. So there are different schools of thought. And of course, share buybacks really should be done when the share price is lower than the perceived intrinsic value, or maybe in the case of insurance companies, the book value, because then that's actually creating value for the shareholders by buying the shares back at lower than they're actually worth. Are we to assume, because Aviva are buying back shares potentially in this £4 range, that they think the shares are worth £5 or more? Let's hope they're thinking that way and they're not just doing it for the sake of doing it. So that is a headline, and let's just have a look at the deck. I'll pick out a few key bits. There's plenty in here, so I'll leave the links below if you want to come and read these on the Aviva Investor Relations website. And I should just say, before going any further, this isn't investment advice. I'm not recommending you buy, sell, or hold Aviva. I'm just sharing my thoughts, what I think about them. So the good news from their perspective is UK and Ireland value of new business is up notably. Costs are down, profitability is improving, including operating profit. These are good things. They believe they're in a position of financial strength. They want to start this new buyback program, as we said. Now, they've said here preference for regular and sustainable return of surplus capital. Now, I do hope that is a dividend approach if they're going to return it, unless they've actually got something better to spend it on themselves. Now, on screen, the return on capital, or return on equity here, is shown. And this is a measure of how well the company can use its own resources and grow. And this figure has increased, as you can see from the graph on the left. And 10.9 is not a bad figure for an insurance company, from my understanding. And normally in the market, you'd want to look at companies that are 20% plus if you want really good return on equities or return on capitals. Certainly been reading Terry Smith, Investing for Growth, recently, and his investing style is very heavily linked to the return on capital or return on capital employed. In the long run, he believes that that is the sign of good management. And also, if a business can invest into itself and grow at that rate using its capital, then that is a great thing. And actually, you don't want as many dividends or share buybacks because you want the business reinvesting that money into itself with those return on capitals. I think what Aviva is saying is they've got better at using money, but they're not sure what to do with that money, so they're going to return some of it to shareholders because they've got too much and they're feeling very steady. but actually the opportunities for them to deploy capital to meet these, to create these decent returns, perhaps they're more limited as they're running a smaller group than they used to, so that's why they're returning excess performance, excess money to shareholders on top of where they think they are on the various safety ratios and that sort of thing. So looking forward, they are looking at this very large cost reduction program of 750 million, which they seem to be on target for. And along the bottom of the screen there, you can see that dividend and capital return 2022, you're looking at 870 million, 2023, you're looking at 915 million. And they want to grow that low to mid single digits thereafter. So you're probably looking at something like 4% a year growth, maybe 5%, 4 to 5% a year growth in that dividend per share going forward. Not actually massively impressive, though if they can keep that going for a long period over time, that will compound nicely. So I'm just flicking to another presentation just to summarise with the CEO's comments. Summary is that their measure of value creation has improved markedly. Operating profit is up nicely, although the word adjusted should be considered when you look into the detail. There's a strong liquidity position. Very importantly for an insurance company, they believe their balance sheet is strong. It feels like quite a good news story. It'll be very interesting to see what happens with the capital returns going forward. With my long-term £1 million, hopefully, challenge, I'm going to continue to hold my 247 Aviva shares. They're worth £1,150 or so. My buys were at £2.47, £2.84 and £3.50. The current price is very much above those. Very nice dividends that have been coming in. I'm really happy with how this company's performed for me, and I'm going to continue to hold. I'm not going to buy more. The company is around about almost 3% of my portfolio, which I'm happy with. I wouldn't mind it going up to 5%, to be honest. But I think buying at 460, it may be fine, but I don't think it's undervalued at 460. Thank you ever so much for watching. Click here to see how Aviva fits into my portfolio as of the latest portfolio update. If you want to know more about the return on capital, hit this one instead, and I'll just take you through the implication of that. Have a good day.